Welcome to the Deep Dive. We're the show where we take a whole stack of sources and really pull out the key insights for you. Today, we're diving deep into, well, a truly foundational book on finance. It's Benjamin Graham's The Intelligent Investor, often called the single best book on investing out there for the general public. It's really designed to give you the emotional framework and the tools you need for financial success.
And what's just amazing, really, is how relevant it all still is. I mean, decades later, Graham's ideas and, the updated commentary helps too. They give you crucial lessons for basically any market, even the wild ones we seem to get these days.
Absolutely. So, our mission today, let's uncover Graham's core principles. We need to understand that really crucial difference he makes between investing and speculating. And we'll explore some practical strategies for both defensive investors and the more, let's say, enterprising types. You're going to hear some pretty surprising facts, some history too, that bring it all to life. Okay, so let's start at the beginning. To really get Graham's approach, which was pretty revolutionary, who was Benjamin Graham? What made his thinking so different?
Well, his Wall Street journey, it started way back 1914. He was just a clerk at a bond trading firm. But he moved up fast, became an analyst, then a partner. Eventually, he was running his own investment partnership. He was known for this, almost microscopic level of research detail, really digging in.
Right, and that meticulousness, it led to some amazing finds, didn't it? Like that Northern Pipeline story.
Exactly. That's a perfect example. 1925, I think it was, Graham finds this company, Northern Pipeline Co. It's trading at $65 a share. But here's the thing. He digs in and discovers it holds at least $80 per share in really high-quality bonds.
Wow, more in bonds than the stock price.
Precisely. So he buys the stock, pushes management, activist investing, before it was really a term to raise the dividends, and 3 years later, he walks away with $110 per share. That's classic Graham value investing right there. Deep research pays off.
That's incredible, such foresight. And he wasn't just good at picking stocks, he saw the bigger market picture too, right? Jason Zweig, who wrote the commentary for the newer editions, he notes Graham's certainty that, quote, all bull markets must end badly. Zweig said that read more prophetically than ever after the late 90s bubble burst.
And that really speaks to why this book lasts. It's timeless. Zweig actually mentions it was the first investing book he read. He was a young reporter back in 1987, just before Black Monday, that massive crash in October.
Wow, talk about timing.
Right. So Graham's insights, they weren't just for the 1940s or 50s. They apply just as much today. Zweig says the book alters how we view the world and renews itself by educating us. It's powerful stuff.
It really is. It drives home that idea that, markets go up, markets go down, but human psychology, that stays pretty consistent. So what does all this wisdom mean for you, the person trying to navigate today's market? Graham draws this really critical line between being an investor and being a speculator. And interestingly, he says it has almost nothing to do with IQ scores.
Exactly. For Graham, an intelligent investor isn't about brain power necessarily. It's about temperament, character. He says you need to be patient, disciplined, eager to learn, and crucially, you have to be able to control your emotions and think for yourself. He literally says this kind of intelligence is a trait more of the character than of the brain.
That's a really powerful idea, character over smarts. He even compares speculating to, like, gambling at a casino, doesn't he? Or betting on horses.
He does. He says, in those cases, the house always prevails. But investing, according to Graham, is different. He calls it a unique kind of casino one, where you cannot lose in the end so long as you play only by the rules that put the odds squarely in your favor.
So it's not just luck then. How does he frame that difference?
He's quite blunt about it. Famously says, people who invest make money for themselves. People who speculate make money for their brokers.
Yeah.
Ouch.
Yeah, that's pretty direct.
And he observed that Wall Street, it perennially downplays the durable virtues of investing and hypes the gaudy appeal of speculation. He even warns against reckless investors, calling the term itself a laughable contradiction.
So it sounds like he really distrusted market hype, that kind of mass enthusiasm.
Oh, deeply. His warning that enthusiasm on Wall Street, it almost invariably leads to disaster, just proved true time and time again. Take the 1969-70 market slump, for example. Leading stocks fell, 35%?
That's a big drop.
Huge. It was the biggest percentage decline in 30 years. And it just shattered that illusion that you could just buy big-name stocks anytime and automatically profit eventually.
And weren't there some major corporate shocks around then, too?
Absolutely. The bankruptcy of Penn Central Transportation Co. in June 1970 I mean, this was the biggest railroad. It absolutely floored investors because, the stock had been riding high just a year or two before, and it had paid dividends consistently for over 120 years.
Unthinkable, almost.
Right. And fast forward to the dot-com bubble. Late 90s, early 2000s, you saw the exact same thing. Experts completely ignoring Graham's warning. The warning was, obvious prospects for physical growth in a business do not translate into obvious profits for investors. Just because a company looks like it's growing doesn't mean the stock is a good buy.
And the fallout from ignoring that was brutal,
That's
wasn't
right,
it?
horrendous. Just look at some examples. The Monument Internet Fund. A $10,000 investment turned into maybe $2,000 by 2002. The large fund left you with less than $1,200 from your $10,000. And some infamous stock picks from analysts like Kramer lost 94%, leaving you with under $600 from 10 grand.
That's just, yeah.
And the analysts themselves fanned the flames, Merrill Lynch's budget saying Amazon would go from $150 to $400. Payne Weber's P-Seek predicting Qualcomm hits $1,000 a share. It was pure, uncontrolled enthusiasm. Exactly what Graham warned about. Speculation, not investing.
Wow, those numbers really hit home. It shows how that emotional wave, that enthusiasm can just sweep people away, even the supposed experts. Okay, so if speculating based on hype is the road to ruin, what's Graham's core principle for building real financial safety? His big secret?
It all comes down to his concept of the margin of safety. That's absolutely central. Basically, it's the difference between the earnings yield on a stock when you buy it. So the earnings per share divided by the price and the interest rate you could get on bonds at the time.
Okay, so it's like a buffer.
Exactly. A buffer to absorb unsatisfactory developments, as Graham put it. Things going wrong, basically. He gives an example. In 1965, a typical stock might have cost 11 times its earnings. That's an earnings yield of about 9%. Bonds back then paid maybe 4.5%. So you had a 9% return versus 4.5%. That's a huge margin of safety, over 100% relative to the bond yield.
Right, a big cushion.
But by 1972, things had changed. Stocks were more expensive, bond yields were higher. Graham calculated there was basically no difference, no buffer, which meant, in his terms, you had a negative margin of safety. Much riskier.
So the margin of safety isn't just a number, it's like this fundamental shield. Buying something for way less than you think it's truly worth, so you're protected if things go sideways. It reminds me of that old Rothschild maxim, buy cheap and sell dear. Seems simple, but it runs totally counter to how Wall Street often acts, right? Which is more like, buy because it's going up, sell because it's going down.
Absolutely counterintuitive to the herd mentality. And connecting this to the bigger picture, Graham really wants you to see the stock market itself differently. Don't think of it as some all-knowing entity telling you what to do. Think of it as, well, a tool, or maybe an often irrational business partner, sometimes called Mr. Market, Graham says. Basically, price fluctuations have only one significant meaning for the true investor.
Okay, what's that?
They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. Any other time, you're probably better off just ignoring the price swings and focusing on your dividends and how the actual businesses you own are doing.
Okay, if the market is just this moody partner offering crazy prices sometimes, how do we resist the urge to constantly check those prices? It's so easy now, right? Just pull out your phone.
It is easy, and Graham knew that temptation. His advice is actually pretty radical, even today. He suggests you would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other person's mistakes of judgment.
Just pretend the stock market ticker doesn't exist.
Essentially, yes. Checking prices constantly, multiple times a day. He'd say it's almost always unhelpful, probably harmful to your mental state and decision-making.
Detachment is key then. But what about those times when the market is going crazy, like real panic selling? Can that chaos actually be useful?
Graham believed so. He thought true market panics, while scary, can create fantastic opportunities for the prepared investor. Think about the WorldCom bankruptcy in 2002. Massive scandal, lots of fear. During that turmoil, even really solid companies, both value stocks like Ball Corp and growth stocks like Stryker, suddenly went on sale. Their prices dropped significantly due to the general panic.
So good companies get thrown out with the bad bathwater.
Exactly. It showed that if you have done your homework, have your margin of safety mindset, and have some cash ready, times of widespread fear can be when you find great businesses at bargain prices.
That makes a lot of sense, turning fear into opportunity. Okay, so Graham lays out two main paths for the intelligent investor. There's the defensive investor and the enterprising investor. He says both are equally intelligent, but choosing depends on what? Your personality, how much time you have,
It really comes down to self-knowledge, discipline, and like you said, how much time and effort you're genuinely willing and able to commit. Let's talk about the defensive investor first. This path is all about safety, keeping things simple, and aiming for satisfactory, not necessarily spectacular results. Consistency is key.
Okay, safety and simplicity, what does that look like in practice?
Well, one key strategy is using well-established investment funds. Things like mutual funds, maybe common trust funds if available, or hiring reputable investment counsel firms. Basically, letting professionals handle the selection within a framework.
Makes sense. What else?
Another classic defensive strategy is dollar cost averaging. This is really powerful in its simplicity. You just invest a fixed amount of money, say $100 or $500 at regular intervals, maybe monthly, maybe quarterly, automatically.
Right, you just set it up and let it run.
Exactly. And the beauty is when prices are low, your fixed amount buys more shares. When prices are high, it buys fewer shares. Over time, this tends to give you a very reasonable average purchase price without any need to guess market tops or bottoms. It's perfect for index funds, takes all the emotion out of it.
Yeah, that automatic buying really smooths things out.
Mm.
Okay, so funds, dollar cost averaging, anything else for the defensive type?
Yes, if the defensive investor is going to buy individual stocks, Graham had strict rules. Limit your purchases to large, prominent, and conservatively financed corporations. And importantly, ones that have paid continuous dividends for many, many years, say 20 years or more.
What does conservatively finance mean in his book?
Good question. He had a specific metric. He wanted the common stock equity, measured at book value, to be at least half of the company's total capitalization. That includes all its debt, preferred stock, etc. Or, for railroads and utilities, which typically use more debt, maybe 30% equity. The point is, the company shouldn't be drowning in debt. It should have a solid foundation of owner's equity.
Got it. Solid companies, long dividend history, not too much debt. Seems sensible. Now, you mentioned growth stocks earlier. Why should a defensive investor specifically steer clear of those? Isn't growth good?
Growth is good for the company, potentially. But Graham argued growth stocks, meaning stocks whose prices already reflect high expectations for future growth, are often too uncertain and risky for the defensive investor. Why? Because their prices frequently race ahead, way faster than the actual profits are growing. Expectations get baked in, and then some.
So you're paying for future hope, not present reality?
Precisely. And that hope can evaporate quickly. He used IBM as an example back then. Great company, but its stock price got hammered, lost half its value twice, once in 61.62, again in 69.70. Texas Instruments was another price rose 5 times faster than profits, then boom, dropped 80%.
Ouch.
And the commentary updates this. Look at Microsoft in the early 2000s, after the bubble. Down almost 56% between 2000 and 2002. Cisco lost 76% in the same period. It just proves Graham's point again. The hotter they are, the harder they fall. Defensive investors should avoid that kind of potential volatility.
That's a very clear warning. Okay, what if a defensive investor feels overwhelmed even by index funds or picking those large companies? What about getting help, like a financial advisor?
Graham acknowledged that getting help is perfectly fine. You could use a discount broker if you know what you want, or a financial planner, or a full-service stockbroker. However, he laid down one absolute non-negotiable rule. You can never delegate the responsibility of checking out that advisor first. Is this person trustworthy? Are their fees reasonable? You have to do that homework yourself. And ultimately, financial decisions should be mutually agreed upon. You retain control and understanding. Don't just blindly follow anyone.
Okay, so vet your advisor carefully. That makes sense. Now let's switch gears to the enterprising investor. This sounds like someone who's willing to roll up their sleeves a bit more.
Exactly. This path is for those who have the time, the interest, and frankly, the skill to put in significant extra effort beyond the defensive approach. Graham outlines 4 main ways the enterprising investor might operate with common stocks. 1 is trying to time the market buying low, selling high, though he was cautious about this. 2, buying carefully chosen growth stocks, if you can find them at reasonable prices, which is hard. 3, buying bargain issues. And 4, buying into special situations, like reorganizations or takeovers.
Okay, that bargain issues one sounds really interesting. What exactly did he mean by that?
This is a fascinating category. Bargain issues, in Graham's strictest definition, could be common stocks selling for less than the company's net working capital alone.
Wait, less than working capital? What does that mean practically?
Net working capital is basically current assets, cash, receivables, inventory minus current liabilities. It's the readily available stuff. So if the stock price is less than that, you're essentially getting all the long-term assets, Buildings, machinery, patents, brand value, everything for free. And you're getting the working capital at a discount.
That sounds almost too good to be true. Do those really exist?
They do, or at least they did. Graham conducted a study back in 1957 that found about 150 stocks meeting that criterion at the time. It takes digging, but these nets, as they're sometimes called, can offer incredible value.
Wow, getting the factory for free. Okay, so finding these bargains is key for the enterprising investor. What else should they look for? Graham had some strong views on company management, didn't he?
Oh, absolutely. He strongly implied that management should always think like owners, not just managers. Their interests should align with the shareholders. And a big part of that is transparency. You, as an investor, should look for clear, straightforward financial statements, not confusing ones full of jargon or, worse, obfuscation.
He had some funny examples of obfuscation, right? Like those special charges.
Yes. He warned that things labeled non-recurring or extraordinary charges shouldn't have, as he put it, a nasty habit of recurring. If they keep happening, they're not really non-recurring, are they?
Good point.
He humorously cited one company believed to be AMF Corp, explaining a $2.3 million special item. Get this list. It included closing UK operations, reorganizing a division, selling a small baby pants and bib company, getting rid of part of a Spanish car leasing facility, and liquidating a ski boot operation.
Baby pants and ski boots in the same special charge. That's quite a mix.
Right. It stretches the definition of special. Another example he likely would have flagged later is Micron Technology. They had inventory write-downs labeled as unusual for 6 consecutive quarters.
Doesn't sound very unusual if it happens 6 times in a row.
Exactly. Graham also worried about companies just sitting on enormous piles of cash, not returning it to shareholders or investing it effectively. He noted Oracle with $5 billion, Cisco with $7.5 billion, and Microsoft by 2001 they had $38.2 billion, and it was growing by like 2 million an hour. It reached $43.4 billion by 2002.
That's a staggering amount of cash.
It is. And Graham pointed out, so long as this surplus cash remains with the company, the outside stockholder gets little benefit from it. Eventually, Microsoft did start paying a regular dividend in 2003, perhaps partly due to this kind of pressure.
Okay, so watch out for recurring special items and huge cash hoards. We've covered speculative bubbles and management issues. What other market follies did Graham warn investors about? Stock splits seem to annoy him.
Yes, he was quite dismissive of stock splits, especially when done purely for promotional reasons. He famously compared a 2-for-1 split to someone taking your dime, giving you back 2 nickels, and asking, "Don't you feel richer now?"
It's the same amount, just different pieces.
Precisely. Yet back in the bubble days, like 1999, just announcing a stock split could make a company's shares jump 20% or more instantly. Pure psychology. Graham felt that managers who used splits just to pump up the stock price were treating their investors like dolts. It creates an illusion of value, not real value.
That's a great analogy. Beyond these kinds of market games, Graham also had some pretty strong opinions about using complex math in investing, didn't he? Which seems counterintuitive, maybe.
It does seem counterintuitive in today's world of quants and algorithms, but yes, he was very skeptical. He stated flatly that the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions we draw therefrom.
Wow. So complexity equals uncertainty.
In his view, yes, when it came to valuing common stocks. He said that in his entire 44 years on Wall Street, he had never seen dependable calculations made about common stock values that went beyond simple arithmetic or the most elementary algebra. He saw using things like calculus or higher math as a warning signal, a sign that someone was trying to substitute theory for experience, often to make pure speculation look like sound investment analysis.
Keep it simple, basically. Focus on the fundamentals you can actually understand and calculate reliably. Okay, that's a clear message. So, pulling this all together, the focus on value, avoiding speculation, keeping it simple, what does this imply for diversification? How important is that?
Oh, diversification is absolutely crucial in Graham's framework for both defensive and enterprising investors, though maybe implemented differently. Its main purpose is really risk management. It minimizes your odds of being totally wrong on any single company and maximizes your chances of capturing the overall returns the market offers. Because let's face it, predicting which specific stocks are going to be the next super stocks, the ones that go up 10,000% or more, is incredibly difficult, maybe impossible.
Yeah, finding the next Amazon or Google early on.
Exactly. There was a study looking at the 30 best performing stocks over the 30 years ending in 2002. The list included some real surprises. Southwest Airlines? Okay, maybe. But Worthington Steel, Dollar General, a snuff tobacco maker. These weren't the obvious tech darlings everyone might have chased. Highly unpredictable.
Good point. The winners aren't always obvious ahead of time.
Right. And that's precisely why diversification is so powerful, especially diversification across what Graham might call middle ground stocks. Companies that combine good size, a solid earnings history, and, importantly, are selling at moderate prices relative to their intrinsic value. Spreading your bets across those helps ensure you don't get wiped out by one bad pick, and you benefit from the overall market's tendency to rise over the long term.
So our deep dive into the intelligent investor really brings it home, doesn't it? Successful investing, it's not really about chasing fads or having a genius IQ. It's much more about character,
Yeah.
discipline, and truly understanding what it is you own.
Absolutely. We've seen how Graham's core ideas, that margin of safety, the vital difference between investing and speculating, how to view market swings, they're just as relevant, maybe even more relevant today than when he first wrote them down decades ago. The market constantly changes, but it always seems to present opportunities for people who approach it patiently, rationally, with a clear head.
And you, listening now, striving to be that intelligent investor, you can use this knowledge. You can learn to manage your emotions, think independently, and actually use those market fluctuations as opportunities, not reasons to panic. So here's a final thought for you to really chew on. Graham defines the intelligent investor primarily by a trait more of the character than of the brain. How will you actively cultivate that character-based intelligence, the patience, the discipline, the emotional control to make smarter, sounder decisions in your own financial journey?